services here at Yerba Buena Financial Partners. If you have any technical issues today, please call Katya at 415-334-8000, and we'll try and get you going so you can hear us. Last quarter, we did a second quarter Outlook webinar, and if you missed that, it's located on our events tab on our website under past events. So please feel free to check that out if it interests you. Today, Bruce Frankel and Andrew Zattel are going to be talking to us about economic events in the first half of the year, how they've affected our investment models, and what we're watching going forward. We'd love to take questions at the end of the webinar, so I will unmute your lines. We're muted right now if we have time. So we definitely want to hear from you, so please feel free to jot down your questions. If we do run out of time, though, I would like to ask you to send that to us either via email, or there's a survey that will come up at the end that will allow you to write out your question, because we do want to make sure those get answered. We work with select clientele to guide and empower them to make informed decisions regarding their wealth. We provide clients with the ability to make a significant positive impact on their lives and the lives of the people and causes they care about. It's important for you to understand our mission, and we have developed a proprietary process called the Wealth Impact Process, where we provide comprehensive education and conflict-free advice, as well as risk-managed asset management with service of the highest caliber. At this point, I'd like to introduce Andy Zattel, who is our founding partner. Andy.
Thank you, Holly, and welcome everyone. Bruce and I and the rest of the team hope you're enjoying your summer and having some fun, and we appreciate you joining us today. We hope and expect that you'll find today's presentation both informative and useful. As has been our custom in previous webinars, we begin with fun with words, buzzwords or phrases that have been spoken in 2013, and today we have two. The first is tapering. What does that word mean? Taping two pieces of paper together? B, changing the width of your pants, or as some like to say around here, Andy visiting his tailor? Or C, the Federal Reserve is lowering the amount of assets they're going to buy? The answer is C. Tapering is the buzzword that summarizes the fact that the Federal Reserve will begin tapering and lessening the assets they're purchasing. Talked about it beginning in 2014. It might even be sooner, as of this morning, as the economy continues to improve. And we're going to talk about tapering. Right. Our next buzz phrase, the Great Rotation. What does this phrase mean? A, the planets are realigning. Kind of reminds me of a 1960s musical. B, the Chicago Blackhawks hockey play. The world,
don't forget the Stanley Cup
champion Chicago Blackhawks hockey play. Or C, the theory that there will be massive flows of money out of bonds and into equities. The answer is C. The Great Rotation is that theory, that the money we witnessed over the previous 5 to 6 years out of stocks and into bonds is about to reverse, resulting in declining bond prices and potentially increasing stock prices. So, what we're going to do today, our objective simply is to take a look at where we've been, where we are, and where we may be going. Point of information, this presentation was in fact compliance approved with data points through June 30th. There are a couple of places in here where Bruce and I, where we think it's relevant, are going to interject some changes and or updates to some of those data points, but everything that you see had to go through a compliance approval process. So where have we been? Let's start taking a look at the markets. Through June 30th, the S&P has been up 12.6%. As of yesterday, it was up 19.01% year to date. Dow Jones Global, not including the United States, was down 1.1%, and through yesterday was up just under 5%. The 10-year Treasury on June 30th had a yield of 2.49, and to start the day today, it had a yield of 2.64. And gold, which we've seen a decline of 28% through June, is still hovering right around 1280, which is about a 26% decline. I think it's important to note here a point of interest that gold was a position that we did own in one of our models last year. We got out of it at the end of the last year, and we avoided that large downside participation or loss that you're seeing on the screen. So what did the experts say? What do they have to say? On January 12th, 2013, in a New York Times article, Bill Miller from Legg Mason said, "The great bond bear market has begun." We believe the bond bull has ended, and it's run out of room. In the same article, Bill Gross, one of the largest fixed income managers in the United States, said, "The juice has been squeezed out of the orange." In other words, there's not much left in this bond market, that it's dry. And Carl Case of Wellesley College said, "There are a lot of reasons to be optimistic, but cautiously so." We are glad to say that these experts actually agree with us. So where are we at? Stocks are at all-time highs. Last week, the S&P crossed 1,700 for the first time. And one of the best first half for stocks since 1999. And people are asking, is this rally sustainable? Should we be buying? Should we be selling? What do we do? These are all good questions. Actually, history would show that following all new time highs, that the market continues to rally about another 28% on average. This bar chart in front of us, these red lines indicate new highs over the last few years, and you could see how highs come in bunches with large gaps in between. So when there's one market high, there's always several to follow, and instead of focusing on the market and how it's traded in the past, we're thinking about where it might be going in the future, and we will address some of the reasons why the market could continue to rally from here, while at the same time, we're very cautious about some of these statistics. And we believe that our proprietary grow and protect strategy strives to mitigate the roller coaster ride of the big ups and downs in the market and allow us to participate prudently as we go forward. Bruce, is there anything you'd like to add about that idea?
Not yet.
Okay, so save it for later. Thank you. In 2012, politics dominated the investment landscape, and investors were obviously distracted by an election year combined with a near catastrophe of the fiscal cliff. Now that these fears have dissipated and economic growth has remained somewhat positive, there's been a drag on the economy. So if government spending and tax increases are chopping nearly 2% from economic growth, and we're still growing at nearly 2%, simple math would suggest that the rest of the economy is actually growing at a somewhat healthy rate of 4%. However, as we know, there are lots of structural problems with the government and in this country that are standing in the way of continued economic growth.
So just a quick, Andy, so given those numbers that you get that are on this chart and so forth, what's not showing up there is the effect of quantitative easing. So if, and no one can answer the question, I mean, if quantitative easing was removed from the economy, how much would we really be growing? So we're going to start to test that here, it seems, as you know, the good old word tapering really starts to get implemented. But suffice it to say that a lot of economists out there believe that even the tepid growth we've seen is in large part due to the propping up of the economy by the Federal Reserve. So
definitely. So let's visit with the consumer. consumers remain resilient. This particular slide basically tells us that retail sales have climbed to all-time highs. We see here that consumer confidence is the highest it's been in 5 years, we know, and through this year has increased from January to May, though statistics, I think, Bruce, you and I were talking yesterday, said it's leveled off since then. So, I mean, the consumer is clearly participating more than he or she was before, but as we all know, it's not necessarily sustainable until we see more jobs and growth in jobs, because it's usually the employed that are spending the money. Wage growth has been at about 2% since 2009, with just one little bubble uptick there in 2011. So it's been kind of anemic as we've been going forward.
Yeah, so unfortunately, these statistics, well, I'll talk a little later. I mean, I don't want to be the wet blanket on the parade here, but the statistics here aren't looking very good either. The vast majority of job growth through the first half of the year has been in the lowest paying sectors of the economy, being retail and the hospitality industry. We'll get into the structure of the employment, which is also not showing good signs, but wage growth is just not happening.
So Americans, though, have been diligently paying down debt. In fact, total U.S. consumer debt, which is, let's say it again, consumer debt, is $1.37 trillion below its peak in 2008. And as we like to say around here, every $1.3 trillion here and there makes for a larger ball.
So this is a good sign for the economy, because as more people pay down consumer debt, they're feeling better, they're more willing to buy homes, they're more willing to shop, and you know, and this is a quandary for us as personal financial planners. We don't really encourage people to go on a spending binge, but the economy, you know, 70% of the economy relies on consumer spending. So.
Right, so we're strengthening our balance sheets, which is great. At the same time, you know, the deleveraging process, as we know, can create headwinds to that future consumer spending and growth. This is a great slide. So speaking of jobs, who actually works anymore? The answer is not very many people. In fact, only 33% of the population is currently participating in the private sector labor force. You can see that in this slide. Another 10% work for the government. And even when adding that, more than half of our population isn't working. A whopping 90 million people could be working, but have simply just given up looking. There really aren't that many new jobs being created. The slide here shows us that since 2000, 15 million, according to this statistic, 15 million people have left the labor force. And even though, as you can see at the bottom, there's been a slight turn in terms of jobs, it's way too slow. And we all know, and I'm going to let Bruce talk about this a little bit more, that sustainable economic growth just isn't going to happen until the job market improves. And you've got some new statistics for us on that.
Yeah, I mean, this is, the people who've been on the last couple of quarter calls that we've done know, you know, I'm a big believer in the labor participation rate. I just don't like all the noise that's in the what's called the U3 unemployment rate. And so, again, the numbers just aren't great. Again, the participation rate is at 40-year lows. Again, the sectors I pointed to that are getting some of the job growth aren't very good. Another fly in the employment, if we really expanded out and looked at what's called U6 unemployment, which is taking into account the labor participation rate, the statistic from the Bureau of Labor Statistics themselves, unemployment would be 14.3%, not 7.6%. And in the past, when we have looked at the structure of all this, one of the things that we pointed to is what do we need in job growth just to stay on pace with the demographics of the society? So there was Brookings Institute did a study, and they talked about how in May 2010 they did the statistics and assumed that we needed 125,000 net new jobs, full-time permanent jobs per month to account for new entrants into the labor force. However, now that it's become clear that the recovery is quite persistent, and we're talking about, we're going on a 5-year recovery here in the economy, they redid the numbers, and as a result of the tepid growth that we've seen, they now project that we need 208,000 net new permanent full-time jobs per month through or until we get to 2020. So another 6.5 years at 208,000 jobs a month in order for us to get back to where we were before. Gallup just came out with their analysis of the job growth. Gallup has their own index, and the job creation index edged down from the previous month, July to June. And federal hiring, as we know, because of changes in the budget, are finally trying to get some control over the budget in Washington. So obviously, we're not having federal new jobs. And just that's the statistic of what I'm talking about the industries. Over 69% of the jobs created in the second quarter and over 57% of the jobs created in the whole first half were created in those 3 lowest economic sectors. And so that points to the problem with the salaries that we talked about. So I personally am a big believer that we're just simply not going to see the economy expand to any significant degree. We're not going to get past this tepid, 1-2% growth rate unless we see job growth. We're not going to see job growth miraculously. As economists say, we need to see a clear, realistic path and programs and things that are going to spur job growth. And I'm sorry that we're not seeing it. I would love to be sitting here saying the opposite, and hopefully we can soon.
That would be great. Thank you. Housing. So where are the jobs? They're here. They're not here.
Right. So good, right? So housing is the part.
Housing is back.
Housing is part.
One of the largest negative contributors to the last recession was the housing market, and now one of the largest contributors to the recovery also has been housing. This particular slide shows how the price of housing has increased double-digit this year. Additionally, we can see about housing starts. And since May of 2012, on this slide, housing starts have trended up. Again, good for the economy. The largest asset for many Americans is their home. And as we were talking about the wealth effect a little bit before, as these assets increase in value, as our homes increase in value, people feel better off and become more positive.
Let's just not make another bubble, right?
Speaking of bubbles, Mr. Bubblehead, Mr. Bernanke, things got a lot more interesting after Mr. Bernanke surprised many of us by giving the indication about, as we talked about before, the tapering and the asset purchase program that was going to be lessened. And a lot of people believe that this has fueled, as we said before, the great stock market rally that we have seen of late. The Fed's raised their economic growth forecast for 2014 and believe major risks to the economy have considerably declined. If the economy is getting better, then that's good for corporate sales, and it means stocks are going to continue to perform well. If the Fed is wrong, well, then we may have some rising interest rates, and which would just be another impediment to consumer and corporate spending, resulting in lower economic growth.
I mean, I think that he's done a remarkable job of messaging, right? So he started some of the messaging that they're going to do this tapering thing of easing back on all the asset purchases, and the stock market responded horribly. But eventually, that messaging has to happen. Eventually, we have to take away the drugs from the addict here. And so the market now seems to be more accepting of the fact that this is going to occur. So you just have to believe that this was all planned. This messaging was planned, and so hopefully we've gotten through a lot of that, because it does create what we call silly season. Silly season.
So the first time I hear it, I'm going to freak out, but the fifth time, it's just noise.
Well, a part of that, but also good news is bad news and bad news is good news, right? So the good news in the economy means that there will be tapering because the economy won't need the stimulus. But then the market participants react in a way that's really negative because they start to question if the growth can really occur on its own. And then the opposite is true. So then if we get statistics out of the economy that aren't very good, then all of a sudden the market participants get all excited, and we see the market go up in that they're hoping that the Federal Reserve will keep the stimulus going. So we have to get through this period of silly season for a while, and this does mean, how is it going to affect the people on the call and our clients? We're going to see, because every time we see this sort of thing happen, that we have some whipsawing going on with the markets and in our models. So people may see us enter positions and leave positions as this sort of thing happens. So we can't expect more of that going forward, but we'll try and moderate that as much as we can.
So given the Fed's intervention, we asked about inflation. And what inflation? We have two slides that are going to talk about inflation here. The first talks about the Personal Consumption Expenditure Index, and because there was great fear that the Fed's QE program would create rapid inflation, and we haven't seen rapid inflation. So here, both the PCE and the CPI are showing prices rising less than 2%, or expenses less than 2%. Here we've got inflation by itself, and you could see since June of 2012, the CPI has basically been at 2% or less. The great concern, I think, in the back of everyone's mind is that inflation is just waiting in the weeds. It's only a matter of time when this cash will flood into the economy, resulting in inflation. At what pace that inflation, we don't know, whether it's runaway or manageable. I love this slide. This basically talks about the shift in the Fed stance has created an incredible increase in the 10-year Treasury. One could see right here that it leaped from 1.6%, if I can use this particular tool, right here, to, whoops, sorry about that. We'll go back to 2.6% right here. That is one of the largest moves in a one-month period for the 10-year Treasury in modern history. Simultaneously, while the 10-year Treasury has gone up, gold has plummeted.
So there's been a lot of Treasury auctions going on this week, and they've actually gone very well. Today's auction went quite well. And so people are still buying U.S. Treasuries. As much as we're concerned about people thinking that bonds are a safe haven, and we're going to talk about it here next when we talk about our models, people still believe that bonds are safe and they won't fluctuate when interest rates go up. And, oh, Lordy.
I'd rather be buying a mortgage last month than this month.
Right.
And gold continues to plummet, as we talked about before.
Yeah, it seems to be stabilizing since the slide was made, so it seems like it's kind of leveled off.
I'm now going to invite Bruce to review one of our models in detail, talking about where we are year to date and what we've been doing there, and to kind of wrap up this part of our presentation. So,
Okay.
Mr. Franklin speaking.
So as we look at this slide here, it's showing our sector model on the equity side and our all-weather bond model on the bond side, combined in a growth with income portfolio, which is one of our most popular portfolios. It represents a moderate risk tolerance, kind of 3 out of 5 on the risk scale, if you will. So in this model, we're permitted to put a maximum of 60% on that equity side and 40% on the bond side. The green is cash, red is fixed income or debt, and blue is the equity portion. So as you see here, from the end of December 2012, we were not fully invested at all. And if you go to the next step of this, Andy, please. So now we see, as we reported for what occurred in the first quarter, we were fully invested through the first quarter, fully invested in our equity sleeve, fully invested in the bond sleeve. As interest rates had started to go down, we were taking advantage of that appreciation in the bond market. If you take it to the next step now, it's going to reveal the rest of the chart, which now shows the second quarter and where we are currently, or as of the middle of July. So you see what ended up being here, where we kept pretty fully invested on the equity side. We started to reduce our bond exposure as interest rates started to go up, so that ended up increasing our cash position. We've since, in June, lowered our bond exposure even more. We got out of a couple of the equity positions that were not doing well, and thus increased the cash portion. And then here, as of July, and this is relatively current as well as we speak today, where the equity portion is pretty fully invested, minimal bond exposure right now. The bond exposure that we do have is in a floating rate investment that actually takes advantage of increased interest rates. If interest rates keep going up, we're going to increase our exposure there. And we will, there is another position in that sleeve that we have designed in order to take advantage of increasing interest or an inflation environment, which we will enter as well. You were going to say something?
Yeah, that we have these two positions in our fixed income sleeves so that we can create our own rotation and not have to be just solely in cash once the interest rates move, so that we can try and capture some return for our clients on the fixed income side.
So as of July 19th on this slide, we had 16 of the 23 positions on the equity side open for 94.5% exposure. Today, that's 17 out of 23 positions at 93% exposure on the equity side. Oh, I have to read a compliance disclosure here, forgive me. Stock investing involves risk, including loss of principal. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, as we just discussed, and bonds are subject to availability and change in price. Now, on the next slide, oh, you're here. This slide, sorry. So this is showing, the scale is really hard on this, so forgive us here. It's difficult because the cash position is so large. So compliance also forced us to remove the names of all of the individual positions, but each bar represents an individual position in the sleeves that we just discussed, same model as the last slide. Where you don't see any bar, we're not in that position. The left side, 2/3 of that is in equities. The right side is the fixed income, and then the big bar on the right is cash. So again, a reminder, 60-40 sleeve here, 60% equity, 40% bonds. And today, in the bond side, I just want to report in the last sleeve, we're only in that 1 out of 7 positions that we have designed in the fixed income sleeve at 17 1/3% of that bond portion, so 17 1/3 of the 40%. I have one, sorry, Holly's giving me the time cue here, but I have compliance, right, so I have to read one more compliance. International investing involves special risks, such as currency fluctuation and political instability, and may not be suitable for all investors. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. That's brought to you by your compliance department.
Thank you, Bruce. And I think I think these last two slides should do a lot to help people understand how we manage those portfolios.
Well, now that we're about halfway through the presentation, at this point, I just wanted to mention that if you are a client and you have not met with Bruce or Andy in the last 12 months, please call Katia or myself to schedule an annual review, because it's important to do these at least once a year. The phone number is 415-334-8000, or you can send us an email, whichever is most convenient for you. And it's also if you need a second opinion service, or you know someone who needs a second opinion service, and please feel free to contact us for an initial assessment, because we would love to hear from you.
So we want to make an announcement here today, and sitting in the room is Marilyn and Joyce are here with us. And Marilyn and Joyce have joined the Yerba Buena Financial Partners team, so we are growing, and we're very excited about you guys coming onto the team, so welcome. Joyce helps support Marilyn, and Marilyn's background is ironically very similar to mine, in that Marilyn did a lot of work in Silicon Valley and with startups and so forth. Marilyn, however, I don't have a Wharton MBA like Marilyn does, so Marilyn comes with great pedigree, and is also a certified financial planner and been a financial advisor for 10 years. So we're very excited to have you two on the team. Welcome, and we look forward to all the great opportunities of us working together.
Thank you. Joyce and I are pleased to be affiliated with Yerba Buena Financial Partners, and we look forward to working together on behalf of our clients and any new opportunities that may come up. So thank you very much.
Great. Andy?
Okay. So next is where are we now? And normally I don't like to read the slides, but I think the current state of the financial markets can best be highlighted by these 6 bullets. We talked about it a little bit before. Rising stock and home prices creating a wealth effect, people getting a little bit giddy, thinking it's good. We're going to have a discussion in a few minutes about a tale of two nations and the disparity of wealth in this country. Consumers are gaining confidence despite structural economic issues. We saw the spending and retail sales going up. Corporations have lowered expectations. We have a couple of funny slides about that. Geopolitical tensions reminds me of Macbeth. Boil, boil, bubble, and trouble. It seems to never end. And stocks are trading right around their all-time highs. So, feeling a little more wealthy, the wealth effect. This slide shows that since 2008, assets like homes and stocks continue to increase in value, and households are feeling more wealthy. There's been a 10% increase in the last year alone, right here, in terms of household net worth. This next slide is an interesting slide. It basically says that not everybody is participating in the recovery. It shows the top 7% of the households in the country have added $5.6 trillion in wealth to the coffers, while the remaining 93% of the population is still a little bit behind from where we started. In the interest of time, we're not going today to show you a video, a 5-minute video link that we do have that really describes and is called A Tale of Two Nations. But, and this video talks about the uber wealthy, the middle class, and the not so middle class, and the disparity in wealth in this country. It's a survey, and the survey is about this apportionment, and what people are being asked is what they think it is, what they would like it to be, and what it really is. We would invite you to see it. The statistics are kind of sobering. And so, Holly, can you tell us when and or where, if it's available on our website?
Yes, I will do my best to get that on the website by the end of the week, so you can look for it there first thing Monday morning.
Thank you. When there's money, people are spending money. This slide, each box on this slide represents a different auto manufacturer. The blue bars show the sales of automobiles between January and May of 2013. And the arrows show the increase, both the top arrows between May to May 2012 to 2013 and the second quarter of 2013. I think we can see here that people are buying more automobiles, and that 15 out of the 16 data points here are showing that money is being spent, and this industry is enjoying that recovery right now. Along the same lines, there are record-breaking art auctions in this country. The red bar here talks about 2013 and the blue bar 2012. And all but one, and I think it's Sotheby's here, there's been a greater amount of spending in 2013 than 2012 on art in this country. So the money is being spent. This is a great slide. My business partner Bruce likes to remind me whenever I'm impatient that one of the keys to happiness is sometimes lower expectations. So what this slide is basically talking about here is that corporate earnings are still increasing at a moderate pace. The chart shows that earnings per share only increased by 4% in the first quarter of 2013. This is only after 2% in all of 2012. And the consensus expectations are 3% through the remainder of 2013. We think it's kind of funny that there are expectations, or there is some thought that there will be significant increases going forward, which we'll talk to in a minute. But lower expectations. More companies are, in fact, stating, as this slide shows, negative guidance than positive outlooks. At a whopping relationship of 4+%, 4.6%, 4.6 to 1 are being negative.
Yeah, ratio. That slope is not pretty.
No.
I mean,
unless you were a skier going the other way.
Mm-hmm.
Then it would be good. Now, as far as what we just talked about before, the expectations for 2014 and 15, these aren't necessarily the corporations. This is government, third party, and the Fed. And kind of what Bruce was talking to before, we've seen this happen before, and then there are revisions. He and I, Bruce, were having a conversation this morning about numbers coming out, people reacting, and the revised versions thereafter.
sometimes they go back a year and a half of revisions, because they really know what's going on. So that's why recessions, in many cases, aren't declared until a year after they've already occurred.
The next thing we were talking about was geopolitical concerns. I really mean it this time. I really mean it. I really do. I mean, please don't cross the line this time. I really mean it. So a wild card in the financial markets is, of course, geopolitical tension. And it was announced recently that the White House intends to arm Syrian rebels who are in the midst of a civil war. And apparently the president of Syria, Bashar al-Assad, has used chemical weapons, which was the red line in the sand,
so
adopted by President Obama.
And then the closing of the embassies and things going on in the Middle East right now. So
right. So Russia doesn't particularly like this particular deal with us supporting the Syrian rebels, and Russia has given asylum to Mr. Snowden as well. And whether or not one thinks that Snowden is a traitor or a whistleblower, we all agree here that he's broken the law, and he's put Americans in harm's way and compromised our security. And that's something that has to be dealt with and reckoned with. Senator Schumer the other day actually suggested that President Obama not go to Moscow for the G20 summit, and suggested that the whole summit be removed from Moscow.
Well, all they're doing, they announced this morning that he's just not going to have a private meeting with, so that's the big punishment. So.
The big punishment.
Yeah, the commentators are having fun.
So besides these particular things, we do know about Egypt would not be a fun place to be this week, and Iran is just a total mess as well. So where might we be going? We're going to take a look at the Fed exit, and we talked about that a little bit. China's economy slowing down, Europe, the Great Rotation, and again, taking a look at geopolitical risks and how it might affect what's happening in the markets going forward. So here again, we can see, we talked about this earlier, the interest rate change on the 30-year fixed from May, right there, to June 27th, right here, over 100 basis points, from just under 3.5% to about 4.5% on a 30-year fixed mortgage. This is certain that quantitative easing certainly made, as one can see right here, a tremendous amount of affordable buying and housing for people. Let's talk a little bit, this particular slide, that's one more slide on the impact on financial markets and the interest rate. If you just go to the bottom line of this slide right here, it's basically using a $540,000 mortgage and shows a monthly payment on a fixed note right there, and the difference between a 4 and 5% is $300 a month. However, the difference, a 3% difference right here, is $1,000 a month. That would have a significant effect on the purchasing power of a property that someone is going to get.
Would it be nice to have a house at $200,000?
Back to Wichita, Kansas. Here we go. Right. So let's talk a little bit about China. China being the second largest economy in the world, with 1/5 of the world's population, 1.4 billion people, who are all starting to scream for and demand and or need goods and services, whether they be cell phones and personal electronics or automobiles or infrastructure for that country, as well as basic social and medical services. China has notched some nice economic growth in the past, but we have some questions about it. What one can see here is that it's declined, and on that slide, and the next slide right here basically shows the Shanghai index dropping 13% since the beginning of the year. I know that there are some things that Bruce wants to share about China and Yerba Buena Financial Partners.
Well, yeah.
The way in which we deal with our investments in China,
right.
Particularly, please.
So we'll talk more about our models and our process here in just a couple minutes, but we had a bad experience in our stock model where we had been using some Chinese companies only to find out that their financial statements were just completely bogus. And so we've set a policy here, I think it's about 2 years ago, we will not invest in any Chinese companies. So individual stocks, that is. So as far as broader funds and other things like that, we do have emerging market exposure. And that's how we do get exposure to those markets, but not individual stocks. But I just have to say, so after China announced their Purchasing Managers Index and their GDP growth for the second quarter, literally 45 minutes after they did that, HSBC came out with their numbers, which completely disputed the official Chinese numbers and have consistently for quarter over quarter over quarter.
The quick revisions.
Right. So, I mean, it's just, so it just suggests, I mean, for example, these indexes, they work at a basis of 50. So anything above 50 is showing growth, anything below 50 is showing contraction. The Chinese PMI Purchasing Managers Index came out and talked about rising to 50.3% from 50.1 the previous month. Again, 45 minutes later, HSBC came out and said theirs, which has been very accurate, their index for the Chinese PMI sank to an 11-month low at 47.7%, down from June's of 48.2%. Again, significantly below that 50 number that would show any growth. And the problem is, partly, is the structure of the official number really is only looking at huge official government companies. They're not including some of the private companies and especially small to medium-sized companies. So we have to look at what the Chinese official government numbers, what they come out with some skepticism.
Thank you. And if it was at 7% growth as opposed to the double digit, which had been before?
So the consumers, right? The big promise of China is that the government can be the marionettes of the economy to have this double-digit growth and bring a lot of people out of poor and destitution and become active parts of the economy and spending consumers, which is just a fantastic thing. And millions literally have. It's worked for millions. But what's going to happen with the population, potential civil unrest, how they handle Tiananmen Square, if that promise starts to implode and the growth is not at these numbers, these 7, 8, 10, 12% numbers, there will be ramifications, there will be problems. So this is one of the things that we're watching and we're keeping an eye out on with our model.
Right, significant deceleration in China with big headwinds for the equity markets around the world. Let's just keep traveling around the globe, and let's go to Europe. Europe is still a mess. In essence, if you look at this slide, and the key on the left, blue would be good. There is no blue. Green is okay. There's a little bit in Eastern Europe. The neutral or beige color is just neutral, kind of anemic growth, 0 to less than 2% growth for most of Europe. And then the terracotta and red colors are showing negative GDP. Even though the central bank, the European Central Bank, is creating a backstop by saying by any means necessary we will prop it up, we have some great concern that it could take a very long time for Europe to recover. Unemployment in Europe is incredibly high. It's just terrific, whether it's the youth in this case. I mean, just take a look at Greece. The youth in Greece, 62% unemployment. The average population, 27% unemployed. If you go to the Eurozone as an average, 24% of the young people are unemployed and 12% in general. So Europe has some very significant structural economic problems, and we think it's going to continue to be a drag.
I'm actually surprised that we haven't seen more civil unrest in Portugal, Spain, Italy, with these kind of youth unemployment numbers. These people.
But a lot of those youths are in school, right?
No, these are people in their 20s.
We were to start a poll in the office here about which country was going to fall out of the Eurozone.
Well, I was prompted by me saying Portugal's going to leave. I mean, they're refusing to agree to any of these austerity demands by the central bank or the WTO or the World Bank. I mean, they're just not going to do it.
Right. So we talked about one of the buzz phrases, great rotation, earlier. And so the theory goes like this, that nearly $500 billion has departed from stocks since 2007, while more than $1 trillion went into bonds and other income-providing assets. You can see here over the last 6 years how that money has moved.
So the MM mutual up there is money market mutual, right? And then equity bonds. So just so people can
clear it. Thank you. And the next slide shows right here at the back end the flow of money moving out of bonds since June. So the great rotation is becoming a reality.
Right, and so just to explain to people, because I think there's a few new people on the call that aren't so familiar with Yerba Buena and our investment process, so just to take a minute. We are not big believers in any way about following the conventional wisdom of managing money. To synopsize it, we do not believe in buying, holding, and hoping for the best and telling our clients to just ride the roller coaster ride and saying, don't worry, it will come back. What we do is follow a very disciplined process of using dynamic asset allocation. We will exit positions that are not working, and when we see something like secular changes going on in the economy, i.e. interest rates are going up, we're not just going to stay in the bond market. This is one of our big concerns, is that we have been taught, the society has been taught, that the bond market is less risky or risk-free. And therefore, we are taught as financial planners to put a larger weight of our clients' portfolios, especially more conservative, older clients, into a heavily weighted bond portfolio. And those folks, when interest rates go up, are going to feel a lot of pain. And that is not something that we agree with here, and will not be putting our clients through that sort of pain. Nothing is perfect. No investment strategy is perfect. We'll immunize people against losses. If we're participating in the market, there is always risk of loss. But again, we're not going to tell people to just buy, hold, and hope for the best and ride that roller coaster ride. It doesn't work. We're not doing that. It doesn't work.
So let's take a look again at the geopolitical scene. This picture kind of reminds me of playing the game of Risk, or Who Sunk My Battleship, when I was a child. We have to be aware of the military conflicts and the effects it has on the economy. There's no question. There's a lot of different hotspots right now. And there appears to be some places that are very close to having war break out. Should superpowers become more involved in any of these conflicts, it could send financial markets into havoc. It could be very severe as to what happens. Not to be doom and gloom. We just have to be mindful of it, and we are keeping a watchful eye. So amidst it all, we want to tell you to remember to laugh. That no matter what condition the world appears to be in, we must always keep a sense of humor. If you can't laugh at yourself, feel free to call and laugh at me. I welcome it. And our parting advice to you here is to try and find something that makes you happy at least once a week, and enjoy it and do it and smile. At Yerba Buena Financial Partners, we remind ourselves and others on a regular basis that the only long-term realism must be optimism, or why bother? So thank you very much.
See you next quarter.
Yes, see you
Thank
next quarter.
Thanks, everyone.
Bye.